To understand South Florida, we must first understand the Eccles Building in Washington, D.C. In 2026, the Federal Reserve's battle against sticky inflation has led to a sustained high-rate environment. Traditionally, high interest rates are the realty killer. They increase the cost of capital, suppress demand, and force price corrections. But South Florida is an anomaly. Why? Because of the in-migration liquidity coefficient. We are seeing a historic decoupling. While the 30-year fixed mortgage rate hovers at levels unseen in decades, the Miami-Dade and Palm Beach markets are being fueled by all-cash institutional migrations. When the Fed raises rates by 25 basis points, it usually cools a market. In Miami, it simply filters out the middle-class buyer, leaving the field open for equity-rich refugees from high-tax states. We must analyze the real interest rate equation. In 2026, Florida, the expected appreciation often outpaces the nominal interest rate. This makes real estate a net positive hedge even at 7% or 8% interest. This section will dissect the velocity of money in the Tri-County area and why the Wall Street of the South doesn't care about Jerome Powell as much as the rest of America does. As we stand in February 2026, the 30-year fixed mortgage rate has settled into a high-altitude plateau, around 6.3% to 6.5%. To the average observer, this seems like a cooling agent. In the rest of the United States, a 6.3% rate has effectively frozen the suburban dream. But in South Florida, we are witnessing a phenomenon called monetary decoupling. The Federal Reserve has kept the federal funds rate elevated. Yet, Miami-Dade and Palm Beach counties are reporting record-breaking all-cash transactions. When you remove the bank from the equation, Jerome Powell loses his seat at the closing table. We are seeing a massive influx of high-velocity capital, wealth that isn't just sitting in savings accounts, but is fleeing fiscal friction. For these buyers, real estate in Florida is not just a home, it's a capital preservation vehicle. Even with mortgage rates at 6.3%, the in-migration liquidity coefficient is at a 10-year high. Florida is currently the #1 state for net migration. That wealth is hitting the market as a tsunami of liquidity that ignores the Fed's interest rate hikes. To understand why people are still buying in 2026, despite high nominal rates, we must look at the real interest rate. In South Florida's high-demand pockets, home prices are projected to rise by 2.2% to 4% in 2026. When you factor in the state tax savings, the effective cost of living creates a net positive hedge. If your home appreciates at 3% and you save 8 to 10% in state income taxes compared to New York, your real cost of capital is effectively zero or even negative. This is why the smart money isn't waiting for rates to drop to 4%. They know that the day rates hit 5.5%, sideline capital will flood the market, causing a price spike. In 2026, the mantra is, marry the house, date the rate, but hedge with the equity. We are seeing a shift where private credit funds are replacing traditional banks. Because the Fed has made bank lending restrictive, private equity firms are stepping in. These firms are looking at the spread. If they can borrow from their investors at 5% and lend to a developer at 9%, they are capturing a massive premium. This shadow banking ecosystem keeps the Florida skyline growing, even when the local bank's mortgage department is quiet. We are also analyzing the absorption rate in the 1NM+ segment. While the standard market is seeing a slowdown in sales volume, the luxury segment is seeing sales growth of 14%. This is a K-shaped recovery. In 2026, we have reached a tipping point in the South Florida housing market that sociologists are calling the Great Credit Divide. For decades, the engine of Florida's growth was the mortgage-dependent professional, the doctors, lawyers, and managers who fueled suburban expansion. But today, that engine has seized. The standard market, which we define as the $500,000 to $800,000 price bracket, is currently in a state of transactional paralysis. Why? Because the math of 2026 simply doesn't work for anyone who isn't bringing at least 40% equity to the table. When interest rates rose and stayed at the 6.5% plateau, they fundamentally altered the debt-to-income (DTI) ratio thresholds for conventional financing. If you bought a $700,000 home in 2021 at 3%, your principal and interest was roughly $2,951. In 2026, at 6.5%, that same loan jumps to over $5,100. That is a 72% increase in the cost of shelter for the exact same four walls. This has created a hard ceiling where a family earning $150,000 a year is now house poor, or worse, entirely disqualified by automated systems. This brings us to the most dangerous phenomenon of 2026, the golden handcuffs, or the lock-in effect. Over 70% of current homeowners in Florida are sitting on mortgages with rates below 4%. For these families, moving is no longer a financial option. It's a fiscal catastrophe. If a family in a $500,000 home wanted to upsize to a $750,000 home, their monthly payment would triple because of the rate reset. Consequently, inventory has become ghost inventory. The houses exist, people live in them, but they will never hit the market. This supply strangulation keeps prices artificially high even as demand from locals drops. The result is credit gentrification. In 2026, if you need a mortgage to buy, you are competing against the liquidity tsunami of all cash buyers. Sellers are now prioritizing certainty of closing over highest offer. In a high-rate environment, a cash offer at $700K is worth significantly more to a seller than a $750K offer contingent on a mortgage that might fail appraisal. The mortgage-dependent class isn't just being outbid, they are being systematically filtered out of the Florida dream. As ownership becomes a luxury, we see the rise of the BTR, built-to-rent hegemony. Wall Street firms, realizing that the middle class can no longer buy, have pivoted to becoming their permanent landlords. In 2026, entire neighborhoods are being built without a single for sale sign. They are 100% rental communities. This is the cap rate compression play. Institutional investors are willing to accept lower immediate yields because they are betting on the long-term scarcity of land. They are using portfolio financing, rates that you and I can't get, to buy thousands of homes at once. For the average Floridian, this creates a wealth extraction loop. Instead of building equity in a home, their largest monthly expense is now a transfer of wealth to a hedge fund's balance sheet. We are witnessing the birth of a leasing society where the path to generational wealth is being gated by interest rate policy. To truly grasp the gravity of 2026, we must look at the residual income gap. In previous cycles, when interest rates rose, home prices typically softened. However, in South Florida, the scarcity of land and the pressure of global capital have prevented this correction. This creates what economists call the affordability cliff. In 2026, the median household income in Miami-Dade has struggled to keep pace with inflation, rising to approximately $78,000. Meanwhile, the entry-level home price has plateaued at $550,000. If we apply a 6.5% interest rate, the DTI for a median family is now 62%. Most conventional lenders draw the line at 36% to 43%. This means that mathematically, the median resident is now unfinanceable in their own city. We are seeing a professional flight. Nurses, teachers, and police officers are moving not because they want to leave, but because they have been calculated out of Florida. If Sections 1 and 2 focused on the individual, Section 3 is about the institutional tremors shaking the foundations of Florida's commercial landscape. In 2026, we have hit the maturity wall. Between 2015 and 2019, billions of dollars in commercial real estate loans were issued across Miami, Fort Lauderdale, and West Palm Beach. These loans were structured on 7 to 10-year terms, with interest rates fixed at 3.5% to 4.5%. Now, the bill is due. As these loans mature in 2026, owners are forced to refinance in a market where the SOFR and bank spreads have pushed commercial mortgage rates to 8% or 9%. This isn't just a marginal increase, it is a doubling of debt service. We analyze the debt yield crisis. In a low-rate world, a 7% debt yield was acceptable. In 2026, with the risk-free rate so high, lenders are demanding debt yields of 12% or more. This creates a capital gap. If a building in Brickell was valued at $200 in 2019, it might only be bankable for $130 today. The owner must either find $70 in fresh cash to keep the building or face a distressed liquidation. The second pillar of this section is the cap rate expansion. For years, South Florida enjoyed cap rate compression, where investors were willing to buy office and retail space at 4% yields because money was cheap. In 2026, the risk premium has returned with a vengeance. When interest rates rise, cap rates must follow to remain attractive compared to risk-free treasury bonds. If a Class A office tower's cap rate moves from 4% to 6%, the math is brutal. That is a $83 million wipeout in equity without the building losing a single tenant. This is the silent devaluation of 2026. We are seeing iconic towers on Biscayne Boulevard technically underwater, not from the ocean, but from their balance sheets. This has triggered the great ownership rotation, where traditional developers are being forced out by venture credit and distressed debt funds. However, the office apocalypse isn't hitting everyone equally. We are seeing a bifurcation of assets. Class B and Class C office spaces, those older buildings without 2026 grade resilience or smart infrastructure, sun dying. They are becoming stranded assets, with vacancy rates exceeding 30%. Conversely, Class A+ ultra-luxury office space remains at 95% occupancy. Why? Because the Citadel effect continues. The firms moving to Miami from Chicago and NYC demand the best, and they are willing to pay $150 to $200 per square foot in rent to get it. Meanwhile, retail and industrial spaces are the surprise winners. Because South Florida has become a consumption hub for the global elite, high street retail in areas like the Design District or Coconut Grove is seeing record rents. Investors are pivoting from desks to dirt, buying the land under warehouses and shopping centers as a hedge against the volatility of the office sector. In 2026, the winner isn't the one with the tallest building. It's the one with the most inflation-protected lease structure. When the debt service doubles and the valuation drops, we enter the most painful phase of the 2026 cycle, the capital call. For many iconic developments in Fort Lauderdale and Miami, the equity has been completely eroded by the rate hike. In 2026, general partners are sending urgent notices to their limited partners. They are no longer asking for growth capital. They are asking for survival capital. If an LP refuses to inject more cash to pay down the senior debt and meet the new loan-to-value requirements, their ownership is diluted to zero. This is where the vulture credit funds thrive. Firms like Starwood or Apollo are sitting on billions in dry powder. They aren't buying the buildings yet. They are buying the mezzanine debt. By purchasing the subordinate debt, they position themselves to loan to own. When the developer misses one payment due to the 9% interest rate, the vulture fund moves in, executes a UCC foreclosure, and takes over a 100 millimeter asset for the price of the debt. In 2026, the skyline isn't just changing shape, It's changing hands in the most aggressive wealth transfer in Florida's history. We are also witnessing a new phenomenon in the Florida courts: lender-on-lender crime. Because there isn't enough liquidity to go around, different tiers of creditors are fighting for the scraps of distressed assets. In 2026, the most valuable asset isn't just the land, it's the legacy debt. We are currently witnessing the great arbitrage of assumable mortgages. For the uninitiated, certain government-backed loans contain a clause that allows a new buyer to assume the seller's existing interest rate. Imagine finding a property where the seller has a 2.8% fixed rate from 2021. In a world of 6.5% or 7% market rates, that mortgage is a financial unicorn. If the spread is 3.7%, the present value of those interest savings over 30 years can be worth hundreds of thousands of dollars. Savvy investors in 2026 are specifically targeting VA-heavy neighborhoods, or FHA-heavy entry-level homes. They aren't just buying a house, they are buying a time machine that takes their monthly payment back to 2021. When banks stop lending, the market doesn't die. It moves to the shadow ledger. In 2026, seller financing has seen a 500% increase in transaction volume across Florida. A seller who wants to move but can't find a buyer decides to act as the lender. The seller agrees to a 5% interest rate, which is a win-win. For the seller, they get a 5% return on their equity, which is better than most high-yield savings accounts or bonds in 2026. For the buyer, they get a rate 2% lower than the bank, making the home affordable again. We dive into the hybrid wrap strategy, where the buyer pays the seller's existing low-rate mortgage and adds a wrap of secondary financing. This is high-level creative finance that requires expert legal structuring. In 2026, if your EOC isn't at least 250 basis points above the 10-year Treasury, the deal is dead. This has led to a massive pivot toward workforce housing and student housing in inland hubs like Orlando, Tampa, and Gainesville. These assets provide the stability needed to weather a high-rate environment. In Miami, we see investors buying zombie condos at 40 cents on the dollar, renovating them to 2026 standards. Beyond simple assumable mortgages, the 2026 market has seen the return of the subject-to acquisition strategy. In this high-rate environment, savvy investors are taking over the existing payments of a seller's low-interest loan. If a seller has $200,000 in equity and a 3.1% mortgage, an investor can pay the seller a portion of that equity in cash. By keeping the legacy debt in place, the investor achieves a WACC that is significantly lower than any bank can offer in 2026. This allows for higher cash-on-cash returns, even in a stagnant price environment. However, this requires a deep understanding of the due-on-sale clause and the 2026 insurance requirements. In 2026, the insurance flip is the dominant strategy, because insurance premiums have become a massive drag on property valuations. Any investor who can materially reduce a property's insurance risk creates instant equity. We have reached the end of this deep dive into the 2026 Florida market. We've covered everything from the Fed's interest rate domino effect to the creative strategies that are allowing savvy investors to thrive. But remember, knowledge without execution is just noise. The data we've shared today, from insurance arbitrage to assumable debt, is your toolkit to navigate one of the most complex financial cycles in history. If you found value in this masterclass, please hit that like button and subscribe. It helps us continue producing this level of high-intensity research. Most importantly, let's keep this conversation going. Follow us on all our social media platforms, Instagram and TikTok, where we post daily market alerts, real-time rate updates, and exclusive behind-the-scenes looks at the deals we are closing right now. You'll find all the links in the description below. The 2026 cycle belongs to those who are prepared. Thank you for your time, stay resilient, and I'll see you at the next closing.